A lot of interesting price action over the last couple of days as we head into September expiration. What happens the week after September expiration? What's happening right now that not only will happen next week but beyond? I break all that down in today's video, as well as we take a look at a stock that broke out today, had a strong resistance level, needed some volume. It's in a weaker sector that has potential to outperform going forward. So let's go ahead and get started. Today is Friday, September 21st, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thanks as always for tuning in tonight. Welcome to those of you watching us for the first time. Glad you found us. Keep coming back for more. Subscribe to our YouTube channel. Mouse over the Market Scholars logo right here and then click that red subscribe button that pops out. Also, click the thumbs up icon that's right down below the video. That tells me, number one, you got something out of the video tonight. And number two, it tells me that you think we should keep doing these videos day after day. Really easy way with one click to give us feedback. Go ahead and do that right now while you're watching. Also comment on anything that stands out to you. You have to scroll down further. Any questions or comments you have, be sure to include those down below. Join our daily Market Outlook email list. There's a link popping out in the top right corner of your screen. Click that link to subscribe. Follow me on Twitter for more content like this throughout the day, as well as join our Market Outlook community on Facebook. All right, well, let's start off taking a look at the market forecast indicator on the S&P 500. You can see we maintain a strong bullish posture, but today a little bit of a down day. It started off strong. By the end of the day, down a point, so relatively flat, though we did come off of the open. It produced a bullish intermediate confirmation signal, which is again the combination of this strong bullish posture with an oversold momentum line. Keeping in mind that the near-term line, how we're getting signs of maturity of this intermediate trend on the near-term line. We're getting more frequent near-term runs that don't last to 7 to 12 days. We're getting longer pullbacks, near-term pullbacks, and not necessarily deeper, but at least longer than the 1 to 3 days. And of course, bearish divergence showing up right now, lower highs on the near-term line after this pullback here, with obviously much higher highs heading into an expiration. One thing I tweeted out here earlier today was this post here from the Jeffrey Hirsch, does a stock market almanac, about the returns that you get on the S&P 500 after expiration in September. Keeping in mind that in our technical analysis class I taught earlier today for our premium Market Scholar members, we have, this is the seasonality right here of this is post-September expiration, what happens right up into that kind of second week of October once the earnings start to come out. And you can see, it's a pretty bearish period. So, is that the kind of move we can expect to see? We won't necessarily go to lower lows, intermediate lows, but could this be the pullback, the intermediate pullback that we're kind of looking for, at least what fuels it? Here's the data of the returns. This is the Russell 2000. Here's the S&P or the Dow Jones returns. So from the last couple of years, been relatively positive, but before that, you can see the week after expiration has generally been a pretty weak period with a few instances of bullishness. Of course, 2001, we all know what happened in September there. So that's kind of an anomaly that impacts the average. But take that anomaly out, and of course, you've got some pretty bearish numbers all across the board. You got a 6.5% drop the week after expiration in 2011. So, from a seasonal standpoint, we are heading into potentially a bearish period of time. Now, again, I've mentioned before, I'll mention it again, I'm not expecting a bear market. I'm not expecting a recession. So anytime I expect any kind of pullbacks, I don't think the world's going to end. I know that usually we either grind higher or we're going to tank. I know that's kind of the binary mode of a lot of investors, but that's not reality. The reality is, this right here, although I did get a lot of chatter, a lot of direct messages and and messages to me about how bearish we were going to be, and this is the start of the markets starting their bear markets and all of that here. In reality, it was just an intermediate pullback that hit Fibonacci support off of that previous intermediate pullback. So again, we're going to get something similar to that. The world won't end, but we'll end up right around these. There's lots of Fibonacci support with lots of volume in this area to hold it up. So again, I've said before, I expect that intermediate pullback to occur sooner rather than later. And as you'll see today, there are a lot of signs that would suggest that we might be headed that direction. One of them is this overbought cluster we got. Getting a little bit of an overbought cluster heading into expiration here. It's kind of an interesting note. We got an overbought cluster heading into October expiration last time. And then coming out of it, you can see there's some weakness there, at least coming out of what was supposed to be an intermediate pullback there. Remember, we never did get the intermediate pullback as expected. We made that move higher in the tax reform, and then of course we finally got that pullback and corrected all that fluff right there in 2 weeks, a matter of 2 weeks there. So we never did get that pullback coming off that cluster. But it looks like multiple overbought clusters here over the last few weeks, and you can see again bearish divergence setting up on the weekly chart as well, which again would just get us down to this 2860 level, which happens to simply be the old high point, which didn't seem that far away before, but now it's not that far down. If I were to draw the Fibonacci retracement levels here, that happens to be right about where the 38% Fibonacci retracement is now, right? And then of course 50% Fibonacci retracement. There's going to be a period of some volume in there. And then of course the 62% Fibonacci retracement is at these old intermediate. So the entire Fibonacci retracement zone on any pullback that we may get happens to sit above the previous intermediate high point that we had. This is, if we pull back, this would be the current intermediate high, and there's the previous one. So again, any pullbacks, it's simply just that. Just look for it like you do here, for the bounce and subsequent new move higher, because again, as you can see on the chart that I shared, coming out of October earnings, that's the seasonal move we expect into the end of the year, right? And again, a lot of factors would suggest we could get a move like that again this year. Take a quick look at the Dow, which I think fueled a lot of this move this week, was to get up to new highs in the Dow. It's got strong near-term trend, no divergence on the Dow there, strong bullish posture. Looking at its weekly chart, same overbought cluster there. You can see we've had similar overbought clusters before. We had that one there, and then a lot of fluff before we had that 2-week drop there. You take a look at the NASDAQ composite, not getting a cluster. Not getting a cluster on the daily chart. Still got a bearish posture here. Extreme low on the momentum line. The near-term line setting up for another bearish near-term low point. Engulfing pattern today. Bearish sign setting up there. And of course, let's go back to the weekly chart on the NASDAQ. NASDAQ got that cluster here when the Dow and the S&P did previously. It has since pulled back off of that cluster, unlike the two large cap indexes. And now finally the Russell 2000 also has a bearish posture, and not trend change, right? We don't have the dark pink shading yet, but a bearish posture nonetheless. The near-term line has been unable to get above 80 this last time, and so far this time. And you look at the weekly chart for the Russell 2000, also getting that overbought cluster a few weeks ago and not able to maintain and pulling back here. So strong bearish trends in the long term, but some weakness in the short term sentiment. All right, a quick reminder that you can watch our Market Outlook video on our blog. Go to marketscholars.com and click on blog here at the top, and you'll see usually towards the top end today's. Remember, this weekend you also get the sector selector, which will be released for our premium subscribers, as well as tomorrow morning I have a usually about a 2-hour long Q&A session with our premium subscribers as well. You can see there, and then Brandon's popular classes that always start out our week on Monday. Remember, we look for your feedback to know that you want us to keep doing these videos. And the place that we find that, what we look for, is whether or not you make these 3 clicks. First, right here, clicking on that heart and liking tonight's Market Outlook tweet. You can also click this image that will take you to your Facebook page where you can like today's Market Outlook post on Facebook, and of course a link right here. And you can share. 52 seems to be about the highest number we've gotten. We've hit it a few times, but looking to try to get that number up to 100. You can share tonight's Market Outlook from the blog with either on Facebook, on Twitter, or LinkedIn, or with an email to any of your peers or colleagues or friends or family. Long-term chart still looks really bullish on the we're rising above a rising 50-day moving average, which is also rising above a strong rising 200-day moving average. The Heikin Ashi looks really bullish. Again, we had a couple weak candles last couple of weeks. We completely offset those with a stronger close, no lower shadow, bigger body. Not as big of a body as we've seen, but still bigger than the last couple of weeks. So bullish candle there. On the Heikin Ashi candle. I did want to point out, go back to the regular candlestick, and then change this weekly chart to this MACD down here to just the 200-day, or where we are currently relative to the 200-day moving average, which is right there. Again, you can see how bullish we are. I mean, we had gotten to an extreme level there, had popped out above this level, and then we actually bounced after that 2-week decline. We bounced pretty strongly and got about this high off the 200-day moving average before another 2, 3, 4-week decline back down to and below on an intra-week basis the 200-day moving average. So needless, not that I'm expecting a big 2-week drop, but needless to say, we are very, very high up above the 200, and it's hard for the S&P to maintain such a strong position. When you look at things like the Dow Jones Industrial Average and where it's at, you can see also very high, especially kind of a blow-off move here this week. And then you look at the Nasdaq Composite, which is coming, at high levels, but still above its 50-day moving average. And then finally the Russell 2000. Which is coming down closer to its 50-day moving average than any of the others, and setting up the possibility for, and again, just an intermediate pullback that would produce a red arrow on the 50. I don't think we're threatening the 200-day moving average anytime soon, but I think we can trade in between here because of how high up above we are that long-term average. Take a look at the 3 green arrow chart. Again, 3 green arrows, MACD and stochastics are rising. You look at the weekly chart, 3 green arrows in a weekly chart and rising. You look at the, where we're at on the stochastics, providing the potential, and on the MACD of a bearish divergence, so lower highs in the MACD and the stochastics, with obviously much higher highs so far in the S&P 500. This was actually pointed out on our Market Outlook community on Facebook. Go to Market Outlook community here. And you can see Greg pointed out that MACD divergence that is setting up. So, there's the divergence. Lower highs on both the MACD and the stochastic, with obviously higher highs already. Another one of those red flags that we might get some intermediate weakness. All right, if you take a look now at the intraday move, you can see it looks like we are much lower, but keep in mind there's about a $1.30 dividend payment that came from SPY. So technically, we should have closed at 293.31, 32. If you look at SPX, which obviously does not have that dividend payment, you can see that's what happened. But you can also see the penning move that we see here on an intraday basis on SPX. So we were at 29.10, and then in 2 days, see, the market moves where it causes the most pain. So the most pain for this September expiration is for us to move higher, and we got up to 29.20 is where we opened, and then it moved all the way up to 29.30, and even today up to 29.40 before closing at 29.30. So that's where we pinned this expiration. I would not be surprised because of that move if we don't jump right back down to 29.10 pretty soon next week and get back down to that level, if not more below that. So, keep that in mind. Again, we can drop down to 2,900 and still be in the upper half of the chart. Now, that's going to start to move, right? So here in another couple of days, Monday will move from this low to that low, and then it will move up to around this low here. So, that this midpoint is going to move up higher over the next couple of days, and we'll get 2910 or just above it's going to, or below it's going to be the new midpoint for the chart. So you look at SPY, and we can do the same thing here. Let's go to the Heikin Ashi really quick for SPY. Let's see, the long-term chart here, and we'll go to Heikin Ashi. So the midpoint of this candle ends up being the open for next week, and based on the math, and that midpoint is right around 290.07. So we'll go back to this chart, and we're going to change this now to 290.07. That's going to be next week's open, and that's probably where that midpoint is going to be, right around that area too. So we can pull back to 291. Remember, this is actually at 293ish, so we can pull back to 291 on an adjusted basis really easily, I believe, early next week. And that's where, getting below that's going to be the new story. Are we going to get below that and then produce a lower shadow and potentially even a red candle on the weekly candle? If I take a look at today's volume, was pretty large. You can see we got a lot of volume here at the end of the day. Big jump in volume. We typically do, but we really got a lot throughout the afternoon as we were pulling back here. Remember, it's the gap that is not adjusted for the dividend. The rest of the intraday move actually is real. So we had a lot of volume here at the end, a lot of selling volume. Here we go. So you can see if you look at the volume candle, whereas yesterday's was big and green with a little red, today's a lot of red and just a little green. So a lot of bearish volume, relatively small range. You can see the range is about 1.4 points. You take a look at the context, 1.4 points, a little bit below average. So we're not too worried about that. But the volume, again, up in this area, 100 million, that's a concerning. Because remember, more days of volume like that brings that red line up. And as the red line comes up, it's usually bearish, or it leads to a bearish move, as we have seen. So, and it's when it starts to fall down, especially you can see here as we were dropping, it was falling down. So a sign here that wasn't so bearish. We got the higher low, and we trended higher. Here we were moving higher during the pullback. And then we peak and we started drawing lower on the red line as the S&P moved higher. So moving up on this line is not a good sign. And you saw today a lot of that volume, not necessarily the best, the most bullish. Finally, if we look at the volatility today, another red flag that showed up. You can see how the volatility is dropping down. You got some divergences. Don't put a lot of stock into technicals on a intraday chart, on volatility in general, but especially on an intraday chart with volatility. But you can also see that we're closing at a lower level for the year, for the calendar year. Obviously not 2017, but for this year, you can also see too that we are extremely low, below 80%. And as we've seen in the past, we either get a jump in volatility pretty quickly or more of a grind higher. Either way, when we're this extremely low, it typically leads to higher volatility. And of course, as we know, higher volatility generally coincides with pullbacks, right? With falling in prices. All right, so to summarize, the posture is still strongly bullish. We are seeing cracks. We are seeing signs of weakness, red flags that would suggest that we're probably getting closer towards the end of this current intermediate run, and that there's a increasing potential and possibility of a pullback, and where there's plenty of support to maintain the trend to a higher intermediate low point, where we can start to look for a bounce into what would be a higher intermediate high point by the end of the year through the seasonality and other technicals that we've talked about before. So I don't necessarily think this is the top of the market. I don't think we're going to tank or enter a bear market anytime soon. I talked about today in my technical analysis class sector rotation, and we use sector rotation to talk about where the institutions are lining up their money right now, and where does that fit in the economic cycle. And based on our analysis, there's still plenty of potential for moves into the end of this year and the beginning of next year. So what do you think? Do you agree with that posture of this pullback and then subsequent, a looming pullback and then subsequent bounce up to new higher highs? Do you disagree with that? Click the link that's popping out in the top right corner of the video there and let me know. Click either agree or disagree. If you click disagree, scroll down to the bottom and comment on what you're seeing that would suggest that this will probably be more than just a pullback, any kind of weakness, or that I'm up in the night looking for weakness at all, that we're really strongly bullish with all these other signs. Let me know what you're seeing that would suggest either side of that equation. All right, now let's talk about what's driving price action here today. And you can see the weakness that we've seen in some of these other alternatives that we saw on Wednesday. A little bit of a bounce in all of them today, including bonds, high yield bonds, and bond prices across the board. So here's the 3-month performance. Let's look at today's performance first. You can see crude oil continues to be a big mover down here at the bottom. Up. See, it doesn't look like it. It's a lot more volatile, but the numbers are bigger than all of these others. So it's a big 9% move over the last 63 days. You can also see the strength today in the dollar after really a lot of weakness yesterday. And you can see that obviously that pressured gold. But look at the U.S. stocks down here at the bottom with international stocks continuing higher. Value stocks held up small gains. Long-term bonds up a smidge, relatively flat. So really the only outliers you have is the dollar and gold opposing each other. Crude oil making a run up higher, and then weakness in stocks, in the U.S. stocks, especially the large, small cap and mid cap stocks. So broad weakness, not just confined to the S&P 500 heading into expiration Friday, quadruple witching Friday. You can see the trends are bearish for bonds right now. Foreign bonds, long-term treasuries, municipal bonds, all bearish trends. Preferred stocks and MLPs also on a bearish trends. Crude oil now on the bullish trend. Agricultural commodities trying to break this strong bearish trend it's had for 3 months. Same thing with gold, despite today. But you can see now the dollar is on its own bearish trend and having a little bit of a reversal that we haven't seen, and that can definitely have an impact on who's going to outperform international stocks or U.S. stocks. Today, international stocks held up where U.S. stocks on a broad basis really underperformed. If you take a look at the calendar, not a whole lot going on today other than options expiration. Of course, next week things change. You got the Dallas Fed and Chicago National Activity Index on Monday. They don't really move markets too much, but the FOMC is on Wednesday. Markets expected to raise rates practically 100%. So the market's not going to be looking at September. It's going to be looking at these odds, which are still right around 80%, 85% odds that we'll get a rate hike in December again. Then it's on to March, right? March has been pretty much a coin flip. A week ago, the odds were over 55%, and now they're at less than 50. So the odds of another rate hike in March have fallen, even though GDP estimates are still relatively flat. They're at 4.4%, and we won't get another one of these estimates until next week when we get GDP. The final revision for Q2 is out on Thursday, and you also get durable goods orders on Thursday as well. And then finally on Friday, you get the Chicago PMI, consumer sentiment, which is the final revision to the University of Michigan survey, and then of course personal income and outlays and expenses. These are going to be some pretty important days from an economic standpoint that will impact the economic surprise index, interest rate hike expectations, as well as GDP estimates heading into the following week. And heading into October. Remember, again, this is the week that traditionally is not so bullish for the S&P 500 coming out of expiration. There's potential for some volatility here, from a new standpoint that can impact and create the volatility that would hit that average. From a foreign market standpoint, you can see now how things are getting a lot more bullish on a foreign basis. So here's the S&P 500 and ACWI. and they continue to be down towards the bottom. India is struggling. India is the one international market that's still below its falling moving average on the bearish trend. It's struggling. But otherwise, you can see, along with the S&P 500, look at everything else. China is above. It's got a green moving average now. Japan, green moving average. Germany is above its yellow at least. UK is at least above a yellow moving average as well. France is green. We talked about India. Italy is above its moving average. Brazil now with a strong move today, breakout move today, above its moving average. Canada above got a green moving average. Same with Russia, and the same with Korea. So we're getting a shift. Now it's not like we're shifting out of U.S. stocks, but we can definitely start to see potential for relative weakness in U.S. stocks compared to foreign stocks heading into the end of the year, especially if we get a more of a sustained bearish move in the U.S. dollar coming down from that Fibonacci resistance, and you can see breaking below that key $94 level. If I were to bring it up on the daily chart, you can see a little bit of bounce back up to that resistance today. But again, unless you break up above Thursday's high, I see today's move as just basically a short-term return move on a strong bearish trend for the greenback. And of course, continued bearishness would lead to, and it doesn't have to go down every day, right? Lower highs and lower lows would contribute to relative strength in a lot of these really beaten up foreign markets. Interestingly enough, if you take a look at the S&P 500, the energy sector was the only one that outpaced. Everything else was down. You can see some pretty strong movers to the downside in some of these. Now, again, dividends can have an impact on ETFs, so keep that in mind. But some relative weakness. You get a lot of red candles. These are all intraday moves, mind you, on these financials. Discretionary is getting an engulfing. Technology, XLC, which includes a lot of big names in discretionary and technology, with an engulfing pattern. Materials pulling back, even though I expect the weakness there to be temporary because that's the dollar strength. These two do well in a weakening dollar environment. Real estate pulling back. Staples giving you an inside day at Harami. Utilities dropping below its moving average. Right now, the only one dropping below its moving average, along with real estate. Interest rate sensitive areas struggling with the rising interest rates. So if you take a look at this chart, you can see here that healthcare and industrials are your best performers. They haven't been. Right, your best performance have been technology, utility, in purple, and you can see now it's lagging behind. You can also see staples holding value relatively well. Telecom, again, interest rate sensitive area, but you can see technology in red lagging behind the market here during this pullback. So we're getting a rotation out of technology in red. Technology in red, and then discretionary in orange, both lagging behind. And now you've got materials in green here, coming up off of some lows. Of course, energy's also been lagging behind. And then finally, industrials, really off of this low point right here from 8:15. If I were to change the time frame here and go to 8:15. There's your industrial sector doing very well. There's your material sector holding up pretty well. Discretionary is up there, and then you can see energy stocks in this brown starting to make its way. Had a good run. It originally pulled back a little bit too much during the decline, and then off of that low point, which would be, in fact, here. Let's actually change this back to a daily chart. Here we go, a daily chart. So off of this low point right about here, there you can see the outperformance in energy, and then there's materials, and of course industrials. Off of this low, which would be the current near-term run, 9.7. So let's change this time frame back to 9.7 now. So last couple of weeks. there is energy, and there's industrials, and there's materials, right? Those are the sectors that have been so beaten up with the strong dollar that they offer a lot of value and opportunity for outperformance in any kind of bullish move in the markets with a falling US dollar. Whereas technology and discretionary, as you can see in red and orange, would be your laggards. All right, Chevron in that energy sector had a really good, strong day today. It had a kind of a bearish candle approaching resistance. It hit that volume here at 120, and yesterday just could not get through it. It tried on the intraday basis, came back down, but with a lot of volume, pushed its way through 120 into this vacuum of volume until you get up to 125. So there's opportunity now for this to kind of, you can see there's potential for some resistance in this area, but not a lot of buying and not a lot of volume in this area. So really easy for it to puncture through that after having gotten through this area, which is obviously a lot stronger resistance level. So good move for Chevron. There's opportunity here for it to continue higher. Obviously with what we've talked about with the weakness in the dollar and the strength, relative strength in the energy sector. We have earnings coming out after October, so we want to try to keep it close. If you take a look at the 3 green arrows for Chevron, we had 3 green arrows and a spike in volume. Again, we needed that volume to get through that volume area. You're not going to need as much volume to get through the next area to continue higher. Above its moving average now, if you look at the 2-line versions of those indicators, MACD and stochastics getting above their midpoints of the charts, coming off of this divergence, bullish divergence for both the MACD and the stochastics, getting above the divergent high point, so a good positive sign. Both the 8 and 17-day crossing above the 30, so a positive development from that perspective. You look at the DMI plus, the DI plus crossing after a brief bearish move on the orange line, getting above 25, back to getting the blue line above 25, or excuse me, that's on McDonald's, sorry. There we go. Getting after this more of extended run on the orange line, finally getting the blue line up there, up above that again, spike in volume on that. And then finally the long-term chart, the 50 and 200-day moving averages here for Chevron, getting back above both. So we had been below the 50 and the 200, and just like that, breaking back up above both. So pretty good sign. Again, we don't have to be too bullish. We can just come over here. We could stay away from the earnings by trading options that expire before, but we can sell the 120 that we just broke up above. We can buy the 115. That gives us a pretty decent opportunity here for a bullish trade, decent odds of success, and we can throw that that slice here onto the chart, and you can see that slice is right below the 120 level, and there's important support now that we just busted through the resistance. Now we have support in that area that can help keep us up above that. And of course, if we do get to the point where we're down, you know what, 111 bucks over in this area, then we'll take that loss, nullifying the breakout. We'll take that loss and just move on to something else. All right, now I want to hear from you. What do you think about the market posture tonight? Remember, you can comment down below on the YouTube video. You can participate in our Market Scholars forums. Let me know what you're seeing, or what you or any comments or questions you have about what we talked about in the Market Outlook video tonight or this weekend, depending upon when you're watching it. I appreciate your time, as always, in watching this. Remember to subscribe to our YouTube channel, click the thumbs up icon down below, and comment, participate in those forums. Follow me on Twitter for more content like this. You can even check the Twitter feed to see the kind of content that I've pushed out there. And also join our community on MarketScholars.com, as well as our Market Outlook community on Facebook. As always, thanks again. Have a great weekend, everybody, and we'll see you all next time.